This real estate investment loan could be hailed as the best option for investors because it requires no income documentation, and it can be used for both long-term as well as short and mid-term rentals. Oh yeah, you heard that right. And it's called a DSCR loan. So are they really the real estate investor's bread and butter, or just another option in a seemingly huge pool of loan options? You'll know all this and more after today. Hey guys, I'm Nicole Rueth, mortgage guru, real estate investor, and the #1 loan originator in Colorado. I'm going to break down everything you need to know about DSCR loans. But before we dive in to how you can utilize a DSCR loan for your next investment purchase, do me a favor, and if you like this video, hit that thumbs up button and subscribe to my channel. I know it seems crazy to think that even in this market, people are still investing in real estate, but they are. Investors today are getting incredible deals on properties as buyer demand has cooled and inventory is up. But that's a conversation I have in another video that I'm going to link down below. My clients that are actively seeking out investment properties are coming to me saying that the DSCR loan is what I want. It's the best program for me right now. And while the DSCR loan is an extremely powerful loan product, it may not be the best fit for everyone. So let's dive into it. DSCR stands for Debt Service Coverage Ratio, which means absolutely nothing unless you understand it. So essentially means a ratio of two numbers, which in this case are your rents over your mortgage debt. So let's say you have a property that rents for $3,000 a month and your mortgage is $2,850 a month. You've got a cash flow positive property. I get a lot of questions about, well, what about utilities and HOA, etc.? Well, you should definitely be taken into account personally when you're budgeting. However, these aren't used when we calculate the ratio of your qualification for the loan. I mean, in essence, in order for a DSCR loan to be utilized, the investment needs to be taking care of just itself. Just like any loan, there will be a monthly amount due that includes your PITI, which stands for principal, interest, taxes, and insurance. That's your whole monthly payment. And so if the property in question, i.e. the investment, can rent out for at least 75% of that mortgage payment, then it qualifies for a DSCR product. And we don't need to verify your income or your employment. So you're probably thinking, well, how does that work? So as an example, let's just say you purchase a property for $500,000 with 20% down at today's interest rate. Your monthly mortgage payment, your PITI, would be an estimated $3,622. So your market rent would need to be a minimum of $2,717 or $2,717 a month. And just how is that market rent calculated? Yeah, so unfortunately, you don't get to determine the market rent. For the purposes of qualifying, an appraisal will have to be ordered and conducted on that subject property, and the appraiser determines that market rent. So even if you planned on renting it out for one amount, the appraiser's number that we use in the calculation could be different. If you're planning on using the property as a short-term or mid-term rental, we use AirDNA to determine the market variable rent. I mean, this is a great option for more, say, resort locations where long-term rent might not cover the mortgage payment, but the real money is in the short-term rents. The calculation for the DSCR is pretty straightforward, but something to note is that almost all of these loans are going to have a prepayment penalty. With most lenders, it's typically 1 to 5 years. So if you refinance or sell that property during that time period, there's going to be a fee attached. That fee could vary anywhere from 2 to 5% of the loan amount. What a lot of people don't realize is that the fee is customizable. Let's say you want to have a 3-year holding period, meaning after 3 years, you know you're going to sell that property and put the money into another project. Well, then we're gonna go ahead and buy down your prepayment penalty at the time of purchase. If the best pricing on a DSCR loan is a 5-year, you're making the max prepayment penalty, period, and guaranteeing to the lender that you're gonna hold that property for 5 years. If that's the case, you're going to get the best interest rate. Now, if you want to buy down the prepayment to, say, 3-year holding period or any iteration of that 1 to 5 years, you're going to pay a higher interest rate and higher closing costs up front. This is where we can tailor the program to you. And we can pay a little more upfront or have a higher interest rate to save you the exit fees. We do this because as lenders, the DSCR loan is more risky than, say, a conventional loan, where they're not a government-backed loan selling it to mortgage-backed securities. I mean, this is a very niche, non-QM product. And in order to hold the value of the loan, we want to make sure there's a guaranteed period where we're actually collecting payments. Another component to be aware of is that the DSCR product interest rates tend to be higher than those of conventional investment loans. I mean, this goes back to the fact that these loans do not fall under Fannie Mae and Freddie Mac guidelines, where your income and your assets would need to qualify within those guidelines. DSCR products offer a lot of flexibility, completely ignoring your work experience, your income, or any other debts you're holding, and solely focusing on that subject rental property. All in all, this product could be an absolute win for the right investor. But my advice is to keep an open mind. There could be another solution that costs less and is just as effective. Well, that's a wrap for today, guys. I'll talk to you soon.